This is video 4 in a series of videos on present value. The problems we have looked at in the previous videos all included cash inflows, and we used the present value function to calculate the value at time 0 of future cash flows. The present value function does not work for more complex problems. For example, you will have some problems where there are cash inflows and outflows, meaning positive and negative cash flows. In those cases, we need to calculate net present value, or NPV, instead of just a simple present value calculation. Additionally, so far we have only explored consistent periodic cash flows. For example, in video 2 and 3, we solved the problem with a $1,000 annuity. $1,000 was received each period. There was no variability in the amount of those cash flows. We could not have used the PV function in Excel if one period the cash flow was $1,000 and another it was $1,500. In that case, we would need to use the NPV function. Let's look at a few examples using NPV. Assume we run a wind energy company. My business has been growing and we are considering investing in another wind turbine. Wind turbines are used to generate electricity. It's an alternative source of energy. In order to calculate the NPV of a wind turbine, we need to estimate several variables. Let's determine what those variables might be. First, we are going to make an initial investment in the wind turbine. This is the payment we will make up front to buy the wind turbine. We will estimate the initial investment to be $3 million, which is a cash outflow, since it is cash we will pay someone else. So I'm representing that with a negative number. I'm using some general numbers based on a publicly available case written by Johnson and Solomon. A link to the case is provided where you access this video. In addition to this initial investment of $3 million, we also need to consider cash inflows that will occur each period. This would include any revenue generated from the wind turbine. With wind turbines, at times there may be some tax incentives that are offered by the government as well. These can be considered cash inflows or reductions to outflows, depending on how we view those tax incentives. Let's consider them part of our cash inflows. So we will estimate our total cash inflows, including revenue and tax incentives, to be $350,000 each year. These are cash inflows, so they're positive. We also need to consider any cash outflows we might incur over the life of the project. So these are going to be the recurring cash outflows that happen each year. These cash flows might include annual maintenance and insurance, for example. Let's estimate these to total $55,000 a year. In some cases, we may be able to get value from equipment we purchase after we no longer plan to use the equipment in our business. For example, with a wind turbine, we might be able to sell the turbine at the end of its useful life to us, either to someone else to use or for scrap metal. This is called salvage value. For this problem, let's assume the salvage value is 0. Finally, we need to know how long the wind turbine is going to be in operation for our company, and we need to determine the company's discount rate. Let's assume the wind turbine will operate for 30 years, and that the company uses an 8% discount rate. Let's go back to Excel and practice this problem there. This problem is going to be very similar to the present value problems we did in video 3. Except in this problem, we have both cash inflows and outflows. We also have an initial investment, which is a cash outflow. So we need to consider how those impact this problem. First, we just need to input the variables we decided on previously. So our initial investment is going to be $3 million. Cash inflows each period we estimated to be $350,000. Cash outflow each period were $55,000. We said we're going to assume a salvage value of 0, a useful life of 30 years, and a discount rate of 8%. Now we have all of our variables that we decided on previously in Excel, so we can calculate present value like we did in video 3 using the present value function. So let's start that function. We're going to use the equal sign, PV, open parentheses. We're going to use the rate of 8% that we cell reference, put in a comma to let Excel know we're ready to go on to the next variable, and then cell reference to the number of periods, which in this case is 30. Our cash flows in this problem, the $350,000 and the $55,000, are all annuities, meaning they're happening periodically, each year, each period. So in order for Excel to make our present value positive, we want to make our total payments negative. So I'm going to start with a negative sign, and then I'm going to use a parentheses, because now we want to calculate our net cash flows each period. Before we had just dealt with cash inflows, now we have cash inflows minus cash outflows. So I'm going to select those cells. I have my cash inflows minus my cash outflows. This gives me a positive amount of $295,000 each period. I want to make that number negative though in total to make my present value positive. The next thing I need to cell reference is the future value, which in this case is 0. That salvage value is the future value. It's a one-time cash flow if we were to actually sell this wind turbine for someone else to use or for scrap metal. In this case it's 0, but I'm still going to stay in the habit of cell referencing to that future value. So I'm going to make it negative again, so my present value would be positive, and select the salvage value of 0, and then I'm going to close the parentheses and hit enter. So this gives us the present value of the annuity portion of this problem. Next, I need to take into consideration this $3 million initial investment that we made in the wind turbine. The way I would account for that is by subtracting the initial investment from the net present value of those periodic cash flows. This gives me a net present value of $321,046. I shouldn't include the $3 million in my present value formula because the $3 million was spent at time 0. It doesn't need to be discounted back to present value. It didn't happen in the future. Its value today is $3 million. So $3 million is already that expenditure's present value. So to calculate the net present value, I need to consider the present value of all the future cash flows and subtract out the initial investment I made in that wind turbine. And that's what we get here with the present value formula, taking the rate, time, the net periodic cash flows, what occurs each year, the $350,000 minus 55, and then the future value, which in this case is 0, but we put in to get into that habit. And then we subtract out the initial investment of $3 million. That gives us our net present value for this problem. Let's take this same problem, but make it a little bit more complex. We're going to go to the second tab of this spreadsheet, the wind turbine 2 example. This is the same problem, except we're going to assume that the cash flows will not be the same each year. So instead of always being $350,000 minus $55,000, we're going to have some variability in the amount of those cash flows. I've already set up a template that will help us to approach this problem. Let's walk through the new variables. I want to assume that starting in year 16, the wind turbine will not make as much revenue as in previous years. So in years 1 through 15, the turbine will have cash inflows of $350,000 like we assumed before. But from periods 16 to 30, let's assume the cash flows drop down to $325,000. This reduction may result from the wind turbine being less productive over time, or even from one of the subsidies that we were expecting to end around year 16. Going on to the cash outflows, let's assume the cash outflows stay at $55,000 each year. So those are the periodic cash flows occurring each year. But we anticipate that every 5 years, we will have another outflow of $20,000 for more extensive maintenance and updating that needs to be done less frequently than once a year, but still throughout the life of this wind turbine. The table I created below takes all of these inputs and puts them into each year. So we can see at year 0, we had the outflow for the initial investment in the wind turbine to buy that wind turbine for $3 million. From years 1 through 15, our cash inflow is $350,000 for each year. Our cash outflow is $55,000 each year. We also have these additional $20,000 that come in every 5 years. So at the end of year 5, 10, and so far 15. At year 16, our cash flows change, so our inflows are only $325,000 from year 16 to year 30, and our outflows are $55,000, with still the $20,000 carrying through every 5 years, at year 20, 25, and then finally at year 30. These cash flows are just cell referenced up to the variables that I input here. So my table already cell referenced to those. You can see I cell referenced to B4 for the inflows for year 1 through 15. And then B6 for the outflows that carried through all 30 years. I also cell referenced to those additional cash outflows that happened every 5 years. The next step for me was to calculate the net cash flows or free cash flows for each year. So I just summed across all of the columns here. So we have all the inflows minus the outflows. These are our net cash flows. They're undiscounted. We haven't taken them back to present value yet. So here's some different terminology we could use here. I could call this free cash flow or undiscounted net cash flows is another term I could use. So again, don't let the terminology trip you up too much. More so just think about what we're trying to calculate here. So this is the net cash flows for each year. Once I have these values, I can go down and calculate the net present value for the whole problem. Remember, I can no longer use the present value function when the cash flows are variable, when they're different each year. So we're going to use a different function in this case. Luckily, the function is well named as the NPV function. To use this function, we start with equals NPV, open parentheses, and we're going to cell reference to the rate that we used, which is 8%. We then want to include all of the values that we want to discount back to time 0. So that's going to be the cash flow at the end of year 1, all the way through the end of year 30. And I'm going to close the parentheses here. This gives us the net present value of the cash flows from year 1 to year 30. Before we are done, we need to subtract the initial investment from the NPV formula. So I want to include the additional cash flow that occurred at year 0 of $3 million. It's already negative, so I'm going to add that negative number to the NPV calculation I already made, and I get a net present value of $215,209 and some decimals. Remember, we don't include the initial investment in this NPV formula because the initial investment occurred at time 0. It's already at its present value. So $3 million spent at time 0 or spent today is already valued at $3 million. We don't need to discount that back a period. The way the NPV formula is set up is that it assumes the first cash flow you include, which for us was this first $295,000. Excel assumes that first cash flow occurs at the end of year 1 and discounts it back 1 period to year 0. And then the second cash flow, it assumes occurs at the end of period 2 and discounts it back to time 0. So if we had included this initial investment, Excel would have automatically discounted that back 1 period, assuming it was at year 1. just because we use these labels over here doesn't actually tell Excel what we want it to do. We're only using these cell references right here to tell Excel that. So we need to be careful not to include that initial investment in our NPV formula, but we do need to factor it in. So we're just doing that separately by adding it to the end here. And then we get our total NPV of $215,209. Now you've been exposed to some of the more important concepts of present value and NPV. There is more to learn to calculate more complex present value and net present value problems, but this gives you a great start and concludes video 4.